So what income does a mutual fund earn, and what does it pay out? Who pays the tax?
A mutual fund will earn its income from interest, from dividends, and from capital gains, because a mutual fund is running an investment portfolio, which means it's making these investments and receiving these incomes. But all these incomes that the fund has received are already in its NAV. The fund publishes something called the net asset value, which is published every business day. So this number will hold and include all the income that the mutual fund has made. However, this will be available to the investor only in two forms. It will either be in the form of dividend when the mutual fund makes a dividend payment, or it will be in the form of capital gains when the investor sells the mutual fund unit. The important thing to remember in a mutual fund is that the taxation of dividend and capital gain are different. So if you are a mutual fund investor, you are like a shareholder. You are a unit holder, which is like a shareholder. So if the mutual fund declares a dividend, you are going to earn a dividend. But if the mutual fund does not declare a dividend, at any time you can sell off the units. The NAV holds all the income that the fund has earned, and you will make a capital gain.
So as an investor in a mutual fund, I earn dividend income, and dividend is exempt from taxation. So I have no tax liability, right?
That is provided you take a dividend option. What a mutual fund does is to give investors two choices. They can receive their income by way of dividend, which is a dividend option, or they can say that they don't want any dividend and they will book a capital gain when they sell the units. So this can be a capital gain or a capital loss. So what happens here is this is a growth option. So in a growth option, there are no dividends paid by the mutual fund. So the investor would sell or redeem the units whenever they need the money. But in a dividend option, the investor will receive dividends as and when it is paid by the mutual fund. And in this case, the dividend is exempt from tax in the hands of the investor. Capital gains is, however, subject to taxation, and capital losses, as we will see later, also has a tax treatment which is associated with it. There is a lot of flexibility to the mutual fund investor to decide how they would like to receive their income, by way of dividend or by way of capital gains.
So if I choose the dividend option, whatever the fund earns will be paid to me. So I can expect a regular income, right?
Not all income earned by the mutual fund is paid off as dividends. What happens in a mutual fund is that there is a number called the net asset value, the NAV. This number is calculated on every business day. This number is going to include all the income that the mutual fund has earned. Interest, for example, is accrued every day, so it is in the NAV. Dividends which are accrued by the fund, and also any gains that the fund manager has made by selling off what he is holding in the portfolio. However, the NAV also includes what we know as unrealized capital gains or losses. So the fund could have bought something at 10 rupees, the market value could be 12. So that is in the NAV, but it's not distributable income, because the fund cannot pay dividend out of what it has not earned. Therefore, the fund accountants will calculate this number called the distributable surplus. This represents realized incomes of a mutual fund. A dividend can be paid only after this distributable surplus is calculated, taken to the trustees, and they approve the dividend that the fund can pay, and the fund can decide to pay off all of the distributable surplus or some of it. For the investor, the income realized and unrealized is in the NAV. Realized, approved distributable surplus is in the dividend.
So what happens to the dividend that is not paid out?
The dividend that is not paid out is anyway in the NAV. Let's assume that the NAV of the fund was 10 and it appreciated to about 12 rupees. Now out of this, the fund accountants have said that 1 rupee 50 paisa is the distributable surplus. This is realized income which technically can be paid off to the shareholders. So the trustees say pay off 1 rupee out of this. So what would happen is the fund would pay off 1 rupee as dividend, but the other 1 rupee remains in the NAV. And this is why a fund will tell you that whenever a dividend is paid, the NAV falls to the extent of dividend, because all that the mutual fund is doing is taking out the realized income or the distributable income from the NAV and giving it to the investor as dividends.
So a fund that pays dividend is better than a fund that does not pay dividend, isn't that so?
It will depend really on the kind of fund you're looking at, because if you're looking at a debt fund is regularly earning interest. In fact, interest is accrued on a debt fund on an everyday basis. So a debt fund is eminently capable of paying a regular dividend because it's earning a regular income. So if you're looking at a debt fund, one that's paying dividend is earning a regular income, all of them will be earning that. But if you're looking at an equity fund, its only source of income is dividend and any realized capital gains. So you will find that the ability of equity funds to pay a regular dividend goes up when the market is moving up. And you will find that there are very frequent dividends that are being announced. But otherwise, you will find that equity fund dividends are a little rarer. So if you are seeking a regular dividend, more than which fund, it will be the type of fund. If you're a regular dividend seeking investor, you should be looking at a debt fund and choosing a dividend option. There might be little sense in choosing an equity fund and hoping to receive the dividend, which might not be really very frequent. And what's also important to remember here is that all the income of the fund is anyway in the NAV. You have the choice of selling off or redeeming the unit and earning that income. So technically, you don't have to wait for the fund to declare a dividend so that you can earn an income. The dividend is coming from the NAV. So it actually, to you as an investor, should not matter so much whether the fund is a regular dividend paying fund or not, particularly if it is an equity fund.